Okay, we're still watching Riding the Bull right here on the market. Well, it's a range-bound kind of a day, but off lows and probably some element of short covering as well is seen in PSU banks and metal stock, which have seen the drubbing yesterday. But we are talking about new fund offerings, and IIFL Wealth has come out with a unique product today for HNI investors, and Amit Shah is here with me to talk about that all the way from Singapore. Amit, thank you. Always wonderful to have you on the show. Let's break up our interaction into two parts. First, let's talk about these offerings which you are making now, the EM strategy fund and REITs fund, and then later we'll talk about markets. Let's talk about the EM strategy fund. How exactly is it going to benefit the investors, and what is the strategy at play in the background?
The EM fund is to give domestic investors in India under Liberalised Remittance scheme an option to look at investing in overseas market and get benefit out of that. We all talk about diversification in a big way, but if you look at most of the Indian investors' portfolio, it's all concentrated towards Indian rupee and Indian asset classes. So through this two offerings, we believe that this would give a good opportunity for domestic investors to get a flavor of good quality stocks available globally and benefit with long-term investments in those stocks.
Amit, which emerging markets essentially would be in your universe, and what kind of stocks in those emerging markets would you go for? Large cap or diversified or mid caps?
We are not an emerging market expert asset manager. So what we have done is we have selected an ETF listed in US, which has 10 basis points of total expense ratio, and we intend to invest into that ETF, which is predominantly investing into large cap stocks in emerging markets.
Any indication what kind of return can it generate, this particular product, Amit?
Returns, one could not kind of comment on it, but I would just give a perspective that this particular portfolio would give investors and investments into companies like Alibaba, Tencent, Baidu, ICBC, so on and so forth. So essentially what it happens is you would be investing in the top quality companies available in most of the other emerging markets, just like as investor invest into India. If one has to see long-term past track record, typically emerging markets as a basket have done reasonably well compared to India as a market. And also, if you see the major components of these basket, they are a good contrarian play to India, because today, if we believe that we are in a upward swinging commodities cycle, then economies like Brazil, Russia, China would be one of the beneficiaries of that. And there is quite a bit of allocation within this portfolio into these three economies.
Right. Let's talk about the next offering, the REITs fund, and this one would be looking for investing in Singapore office space. Now we all know and have read widely that Singapore clearly is becoming a melting pot for talent across Asia. People are going there, companies are prospering very well. What kind of growth does this fund look at capturing for the investors?
So this is not only Singapore, real estate. It's actually a global diversified REITs fund. What we have done is we have identified sectors which we believe, would benefit out of the global growth, which is healthcare, senior living, where we are investing into ETF in US, which has senior living REITs. We are investing into Asian hospitality. We are investing into office spaces. So as you rightly pointed out, there is a lot of action happening in especially Singapore, Hong Kong, and China, where because of the economic growth, the office space requirement is growing reasonably well. Now, all these REITs, typically, if you look at it, come at a yield between 5.5% to 7-8%. But this should not be looked predominantly as a fixed income instrument. If you look at it rates globally, the 10-year GSEC has already moved closer to 3%. Our view is that interest rates should stabilize, in this range plus minus 25 basis points, and that's where we believe that this could be a good time for long-term investors to participate in global REIT product, which gives them exposure to some of the interesting sectors like hospitality, senior living, office space, so on and so forth.
Right. Amit, let's shift focus and talk about Indian markets now. IIFL Wealth's analysis of the market right now, in the light of how last 12-15 months have been, what's your analysis? What are you recommending your investors to be continue to be invested in the market, book some profit? How's the window looking next 12-15 months far out sitting here?
If you look at last 15 to 24 months journey, most of the investors who 24 months back, just coming out of 2013-14 volatility, and seeing the upswing of 15 and 16, most of them were still skeptical about equities. Now we have seen in most of the HNI portfolios, equity levels, depending upon the risk profile and time horizon, ranging between 35% to 55%. I think currently where we stand, we believe that that's a fair allocation into equity for long-term investors. We don't believe for the next 12 months, markets are going to be a one-way street. There is going to be a lot of volatility, but I think within that, for a long-term investor, equity as an asset class, according to us, we believe that can give a good post-tax risk-adjusted returns.
Amit, any thoughts on the way earnings season wound up? What are your strategists at IIFL telling you about how the broad growth could be for corporate India? Not this year even, but I'm talking about say FY19 or thereabout, FY20. Do you see earnings growth come in a more wide fashion, and hence market also getting a booster from that?
I think our belief is that with demonetization and GST in place, it's one of the big beneficiaries to the organized sector. When I say organized sector, is basically the sector which is on the listed space. So I think from a growth perspective, we've already seen that picking up, and for the next 12 to 18 months, our view is that growth trajectory would continue. Our GDP growth rate itself as an economy should be quite reasonably good, and if that happens, obviously one would see some reflection in valuations also. The current rise in the markets which we have seen in the last 12 months is essentially based on that particular forecast, and we believe that we are right on track. Save any global major issue happening, I don't see a reason why from a next 2 to 3 year perspective, India should continue the growth path and good quality companies, giving double-digit returns.
Just one last word, Amit. In the light of what is happening here in India in the PSU banking space, before that the long-term capital gain being taxed as an issue out of the budget, what is the FII community there in Singapore which run money here, or India is a part of their basket, in your peer group, in your friend circle, when you move around, how are they looking at these factors as a part of Indian market?
Let me answer the easier question first, which is the second question regarding long-term capital gains. I think long-term capital gains, according to me, is not a big issue. We had long-term capital gains tax in past also, and most of the developed economies today, if you look at it, have long-term capital gains tax in their home country. So when a global investor is investing in India with a 15% plus returns expectation, long-term capital gains tax amount is not going to deter him, to invest into India. Is investing broadly for a good macro India story. So my view is, obviously it was kind of a bit of a disappointment, but it should not be something because of which FIs would not invest into India. So our view is the flow would still continue, because with so much of global capital available and very few places where growth is being seen with reasonable consistency, I think India will get its fair share. answering the first question, I think it's quite disappointing, and the reason I say that is every time, you feel India is cruising in the right direction and something like this happens and, we go a few steps back. The issue is not about one company or what happened with that company and whether the company will come out of it or not. It's just about what reputation, the country would carry in eyes of global investors. And most of the companies in India, most of the promoters in India today, if you look at it, they are pretty clean and they are doing honest, genuine business. But because of these kind of events, question marks are put on corporate governance. So that's something which is a bit disturbing. But otherwise, overall, I think we have been quite a resilient economy, and probably in the next couple of months, we will get over this issue and move on, because underlying growth is still quite stable and strong.
Right. All right, Amit. I'll let you go on that one. Thank you so much for your time. Look forward to meet you whenever you are here next. That was Amit Shah of IIFL Wealth joining us from Singapore to talk about markets and of course the new products that they have launched. With that, we are completely out of time on this session of Riding the Bull. Thank you very much for watching. Closing trades will take the action forward.